the rupee is falling. Does that mean the Indian economy is failing? Not necessarily. To understand why, we need to look beyond the headlines and distinguish between a currency's price and economic health. Think of the exchange rate as just one relative price, the cost of the rupee measured against another currency like the dollar. Economic health is assessed using growth, productivity, investment, employment, and inflation. These are the core pillars of our strength. It also depends on fiscal and external sustainability, along with the health of our corporate and banking sectors. Steady capital flows and long-term investment are far more critical indicators than the daily exchange rate fluctuations. So why does the USD INR pair move? It's not always about internal weakness here in India. USD INR can move because of global dollar strength, US interest rates, or a general sense of risk aversion. Capital flows, import demand, and inflation differentials also drive expectations, shifting the rupee's value globally. Interestingly, a strong economy can actually coexist with a weaker currency due to rising domestic activity. Higher activity increases imports of crude oil, machinery, and electronics, all essential components that drive our growth forward. This increased demand for foreign currency can put natural pressure on the rupee even while the economy thrives. Of course, a falling INR can contribute to imported inflation as goods priced in dollars become more expensive. If a barrel of oil costs $80, at 80 rupees to the dollar, it costs us 6,400 rupees. But at 90 rupees to the dollar, that same barrel now costs 7,200 rupees purely due to the exchange rate. However, this depreciation does not translate mechanically one for one into domestic inflation. Other factors often mitigate the final cost. A falling INR hurts some people and businesses while helping others depending on their foreign currency exposure. Imported goods and foreign expenses like travel or education become significantly costlier for the average consumer. On the flip side, exporters and companies with foreign revenues benefit as their income converts into more rupees. To truly understand the situation, we must distinguish between two very different scenarios for a falling currency. In scenario A, the INR falls due to broad dollar strength, while India remains fundamentally strong and productive. In scenario B, the fall is driven by deteriorating domestic fundamentals and a loss of investor confidence. Same drop, different meaning. Focusing only on the dollar rate is incomplete. We should look at the real effective exchange rate, or REER, R-E-R-E-E-R, measures the rupee against a basket of currencies, giving a broader view of our external trade competitiveness. Ultimately, what matters to individuals is how income and wealth change relative to domestic prices. A weak INR is not synonymous with Indians being poorer by the same percentage. It's about real purchasing power. Indians aren't poorer by the same percentage as the depreciation. Domestic productivity and growth determine our real wealth. So don't ask only whether the rupee is falling, ask why it is falling, and look at growth and productivity. Check the numbers that matter: inflation, capital flows, and purchasing power. Those define our true economic health.